As we've seen with Donald Trump, he is incredibly innovative when it comes to policy and other things, and that would have been one of our Grace Swan events, unlikely but highly impactful event, and there is a possibility. It's not our base case, don't get me wrong, not our base case, and we honestly believe, if Trump is looking to fire Powell to get more rate cuts, all he's really getting is credibility cuts. He is not doing any good for the market by doing this. I think Powell's done a fantastic job. He's got through COVID, he's got through the huge increase in rate hikes. Markets still hold up pretty well. I think, as Kennedy said, Tiger Blood staying strong to his cause. He has support. I think Powell will fight to the bitter end to keep his job until he wants to move.
So here's the thing, right? And he's up to bat, I think, May of next year, right? So he's got, I guess, 12 months if he manages to survive, right? It seems to me that the president is trying to sort of not just, deflect a lot of attention away from himself and his policies onto onto Powell, excuse me, but also potentially to set him up. If things do go south, right, whether it's because of what Trump does or what Powell does or does not do, it's Powell's fault. It seems to me, ahead of midterms especially, what Trump is, what his approach seems like.
And Martin, you're right that this is probably the toughest challenge he's got. He's got inflation potentially spurring up again. That's what happened in the 1970s. They got it kind of under control, and then it ran away again. They don't want to repeat that. No central banker wants to see that. Tariffs is creating this potential. Growth is coming off. Stagflation risk is definitely rising. Central banks are under pressure to do this. We've got treasury struggling. You're seeing a lot of the curve steepening. There's a lot of factors going on that Powell has to monitor. At the same time, he's got this kind of headwind where, to your point, Trump is looking for a scapegoat. And as we know, markets look for that pressure point. They look for where the most pain is, and they push on that as far as they can until they get a reaction. Yeah. So now the question is, will we get a reaction from Trump, or will we get a reaction from the central bank? And that's really the uncertainty.
Or will we get a reaction from the bond market?
Yeah. Well, I think the bond market is going to keep pushing. I think we're going to have continued steepening. We're going to have continued difficulty in plain duration. So we were talking earlier on about rates in the 10 years. I think the 30 year is probably more important. I think we're going to get through the 5% in the 30 year. And maybe as we start getting close to 5.5, the market will really start stressing.
5.5 on the long bond. Okay.
On the long bond. But that's still some way away, right? We're only at 480, but that's a pressure trade for me.
Yeah, we were almost at 5. Sherry, come in on this.
Yeah, and Gareth, over the weekend, I saw a lot of posts talking about, given the scenario of a 15% market drawdown, that to fast forward 5 years, the return on average would be something like 66%. If you wait for another 5 years, so on the next decade, it would be 185% on the S&P 500. Is it time to get back in or still stay defensive when it comes to the equity side?
Sherry, I think that's probably, asset allocation is the key question investors should be focusing on more than what the Fed and Powell's doing. This is an environment where it's not about predictions, but precision. It's about setting up their portfolio. And to your point, is this the time to rotate into the U.S.? We don't believe so. We believe, at least from our investment committee as early as last week, that the rotation trade will continue. People are still heavily overweight U.S. I mean, only a few months ago, we were, a global portfolio had well above 85-90% in U.S. assets. That's not a global portfolio. We're seeing still a lot of rotation into Europe, into Asia, particularly Japan, and that will continue. This week, particularly, if we think about all the earnings that's coming through, we think of some of the PMI numbers, the volatility around the central banks. Is this a catalyst for a sustainable turn in equities? Probably not. We could get some tactical trades, and there's definitely some opportunities, but from an asset allocation perspective, we're still well underweight to equities, fixed income a little bit more neutral, overweight alternatives, and we like holding cash at 4.5%.
Talk to us about the alternative ideas, actually.
Yeah, well, for us, alternatives is a parts of the market where we get resilience. It's about structure largely. Private markets, you don't get the same liquidity, but arguably you don't need daily liquidity as an investor if you're looking for the long term. So we think gold is by far our largest overweight in alternatives. We pick gold in alternatives. That's been a great trade, and we continue to like that. Secondly would be hedge funds. Hedge funds, you pay professionals to manage risk. This is the time they need to step up. This is the time they are stepping up, particularly global macro. They're doing really well. And then the private markets, they're giving you a decent return for your risk.